Welcome back to Analysis Review, where we take a deeper look at the big stories in the FT. NYSE Euronext and Deutsche Börse plan to create a global trading powerhouse in stocks and derivatives, raising questions about the role of exchanges. Meanwhile, in the UK, banks and politicians remain deadlocked over such petty matters as bonuses, lending, and whether our banks are too big to fail. With me here to discuss these issues are our banking editor Patrick Jenkins, FT columnist John Plender, and the editor of FT Trading Room, Jeremy Grant. Jeremy, let's start with you. You've been following the whole all the action in the exchanges. Without taking us too deep into the complicated world of dark pools and so on, what's going on? What's driving this?
Well, it's quite useful to think of this all a little bit like what happened with the airline industry, where you see the large airlines getting bigger and bulking up and creating size. In the jargon, it's all about building scale, and this is really no different. The exchanges around the world, particularly the ones that were merged in the last wave of consolidation back in 2006-07, have experienced an incredible amount of competition in that last 5 years from smaller platforms that have emerged in share trading, thanks largely to a lot of regulatory changes. So they've seen their market share in cash equities, share trading, shrink, and they decided we'd better bulk up and get bigger. And as you alluded to earlier on in the introduction, it's also about building business in derivatives, which is one way to get away from those smaller competitors.
And has this been driven by technology? Or
absolutely crucial. I mean, in many ways, you can think of an exchange as a glorified technology business. As some people might know, exchanges are building these big vast boxes, these data centers, to encourage high-frequency traders, so-called, to come and put their computers next to the exchange's machinery to make the trades move faster. It's really about that. It's no longer about pits and human beings standing in a pit and shouting orders at each other.
Okay, well, John, I mean, where does this leave those outside of all this sort of tech with the investors? I mean,
that's a very good question. I mean, in effect, as Jeremy says, what's going on is a kind of technological arms race. But the people who get left out are the retail investors. But I think there are other people who get left out. And I think the thing that worries me most of all is that as the volumes on formal exchanges are falling at this rather frightening rate, and businesses going out to these other platforms and dark pools, these other platforms are not listing authorities. So what happens to the primary market? What happens to IPOs? And I suspect that what happens is actually you get a division between the really big corporate sector and the rest is possibly going to have less access to capital and more expensive access to equity capital.
So extending that, when we stand back and look at the real economy, is that what you're saying is basically there will be less capital?
Well, I don't think there will be less capital. The question is who actually gets it and at what price. But I think that from the point of view of the real economy, the part of the economy that generates jobs and where the real growth impetus lies tends to be in below the top level, and it's very important that small and medium-sized business does actually have access, does have an ability to get up onto the exchanges where they can raise equity capital cheaply. And I think that is the big question in terms of what happens to economies as a result of this.
Okay, well, Patrick, bring you in. I mean, you follow the banks. What are they making? They're big players in all of this. How are they viewing these developments?
Well, I mean, they're at loggerheads, really, with the exchanges in a sense. They're both their customers and their rivals, in the sense that, a lot of the dark pools that John mentioned and Jeremy alluded to are backed by the banks. That a lot of these rival trading platforms are backed by the banks. So the bigger the exchanges get, the more of a competitive threat they become to them. So there is understandable resistance from the banks towards this, but equally they are essential clients.
Are any of them going to challenge this, do we think? I mean, there's been talk of, there's obviously they've got to clear some regulatory hurdles. That might just be a formality, but or is anyone actually going to raise their hand and say no?
I don't think anyone will raise their hand and say no, because no one's made a compelling argument to say that this doesn't make any sense. But what is interesting, pick up on Patrick's point, the banks are somewhat conflicted, because he's quite right. They don't like the fact that the exchanges are bulking up and the market power of the exchanges is expanding. But at the same time, going back to John's point about technology, they absolutely love the technology savings that are coming from slamming these two exchanges together. So there is a kind of this is quite what, to me, this is what's so interesting about this deal, is how remarkably uncontroversial it has so far proved in its 4, 5, 6 days of life to be, for these reasons. As soon as you think you find somebody who's going to be against it, you actually flip the coin and see that other sides of the house of the same business might actually quite like it for different reasons.
That's exactly it. And within the banks, you have two factions, if you like. So some that want it, some that don't.
It's somewhat more nuanced than one might think.
Yeah. John, just picking up on something you raised earlier. I mean, for the corporates, we're seeing situations where now companies whose shares used to traditionally be traded on one or two exchanges around the world, suddenly they're being traded all over the place by people they don't know their shareholders anymore as a result. How do you think they'll respond to this? Does this actually matter? I mean, is that just the new world they've got to live in?
I would be surprised if they're not feeling very uneasy. I mean, as little as 10 years ago, if you were the chairman of a company and you sort of looked at what was happening to your share register, you could actually identify quite clearly that some big transactions were going on, and you could see what that meant in terms of the identity of your owners. Today, with this technology, in effect, the sort of computers are sort of squirting out small transactions at a fantastically high rate. And your share register in real time, as you look at what's happening, just doesn't mean very much. Now, it would be a very strange company that wasn't concerned at the fact that it was much harder to keep a grip on what was happening to your ownership. And that's particularly awkward if, for example, you know that there are predators around and you're worried about where you stand vis-à-vis potential hostile takeovers, for example.
And actually, of course, we saw this with hedge funds, I think. This is the early sign of it, exactly this phenomenon. 5, 6, 7 years ago, when hedge funds were, involved in M&A, and again, a lot of companies didn't quite know who owned them. But this is, I think John's right. There is a much bigger issue here because of technology and what is sometimes called high-frequency trading, the squirting out of orders.
Yeah. Ironically enough, one of the big examples of where that first came to light 5, 6, 7 years ago was in the proposed merger of two stock exchanges, with the London Stock Exchange and the Deutsche Börse.
Yes, and the Deutsche Börse had these Atticus and TCI. I think they were the hedge funds at the time.
Exactly, and of course they killed the deal.
Yeah.
Right.